Hey, everybody, I'm Pete Carmasino, Chief Market Strategist here at Chaikin Analytics. Thanks for joining me today on the Halftime Show here on StockCharts TV. We do this each and every week. And the last couple of weeks, we've been really incredibly busy with our new launch. One of our new letters came out, and just an overwhelming response. So we thank for those of you who were able to join. And it's been a whirlwind of the last couple of weeks, especially with the shortened week and holiday. Just a lot going on. And you know what? The markets are no different. We're down about 1% right now across the board. Just seeing the NASDAQ, obviously the Dow and the S&P 500 kind of all off. I mean, look, taking a break here. It's had a pretty good run in the last month or so. And there's been some names that have been breaking out. There's been some retail names that really started to look good. I can't say that they're not interesting. They are. But it's sort of hard to kind of get behind that at this particular point. What we're seeing is large inventory build inside of these big box retailers, the multi-line retailers, specialty retailers like, your Macy's, your TJ Maxx, your Ross stores, things like that. You're seeing incredible markdowns, which obviously is going to eat into profitability, but you can't ignore the stocks. I mean, the stocks have been pretty interesting. I'm cautiously optimistic, to steal a phrase that's really old and has been repeated a million times. But at the same time, I realize there are some sectors that are still looking strong, like industrials and materials. And we know what happens there, right? We know that chemicals are really one of the leading indicator sort of commodities, right? You can't really build anything or create anything without the chemicals that go in them first. And that sector is starting to, be very attractive. Industrials have been. We've been calling that out for several weeks now. And we're just going to look at some names here that look to be interesting from the standpoint of a sector rotation. And we'll go over the sectors today as well. But also, I do have about 30 names that look to be sort of rallying, but on weak indicators. And so I would name them sort of fade the rally names. And again, not in any specific order. I'll try to pick out a few. I can't go through all 30, but you'll see most of the list up there, and you can sort of stop the video and take a look and make your own determination from a technical basis as well. So let's get into the charts and see what we see. All right, everybody, let's start with sort of a top-down analysis of some of these sectors here. And, I like to look at the relative sort of the ratio, right, between the spider select sectors and the SPY. Why? Because they are tradable, right? The SPY is the index, sort of mimics the S&P 500, obviously. And there's a fee on it, so there's a drag on performance. It's not going to be exactly the same as the index, but it is the only real way to get exposure. There's several other index funds, I should say, but I use the SPY versus the sectors. And just to get myself sort of a ratio, kind of an understanding of where money might be flowing versus the markets and how they're reacting, right? And so we're going to go over the sectors, and then I'm going to look at sort of a new indication of a lower target on the S&P, something that's formulating from my previous sort of projection of a downside, which hit 3750. I'm using the same analysis to find this a new target, and that's going to be later on here in the charts. But quickly, some of the best performing sectors have been obviously energy. We've been talking about this for over a year. We're probably November 10th last year in our newsletter to our subscribers. We were calling out the energy sector, reiterated it in December and January, and really have been following this for quite some time now. Look what's happening. We started to see these names sort of change trend right around here, and really the beginning of the year, that ratio broke out. And so you can do the same thing on here on the ACP platform, but that's really simple to do. But energy still looks good. So let's look at financials here. XLF, and XLF is also very strong. I mean, I had drawn this and had called out the incredible frustration of trying to find a direction in the financials. And obviously with rates being higher, you would have expected this to happen sooner. But with higher rates comes a bit of a slowdown in lending and some other areas of the banking and financial world that are the assets in to financials. Deposits are liabilities, right? So what are you seeing? You're seeing the deposit interest rates take a slower climb than the lending rates. And so over time, that's going to add up to better profit margins and things of that nature. And that's a really high level view of the financial world. But in here are also insurance companies and things of that nature. So, it's a good mix of names, and really starting to produce something here that's very, very interesting. Names like JP Morgan have already broken out. You're seeing a name like Citizens Financial Group, CFG. I'll look at that chart if we have time. Also looking interesting. So again, this sector is really promising and has a lot of opportunity in it, looks like. XLV, which has been a defensive sector for ever and ever, has really done its job from a relative basis, but at the same time, you're not really seeing absolute return. Now, you're getting a nice base here, a sideways action on a longer term look over a year of consolidation sideways, but versus the S&P, obviously it's done better. And that meant that this was defensive, and it kind of did its job. Now, it had its periods of selling off, but XLV still looked interesting. There's probably some names in there that still are available to kind of start picking at. XLI, the industrials have done extremely well. A little bit of a negative downward trend here in 2022, obviously, but overall has picked back up. And again, from a relative standpoint, has done really well. And some industrial names are still looking, pretty strong. Now, here's the materials. We were talking about this earlier. This isn't, there are some metals and mining stocks and things of that nature in here, but mostly made up of chemical names. And you're seeing a sharp change here in trend since the middle of November, right? Just a few weeks ago. So that's promising. And I think that basically starts to be an area and a pond that we want to fish in, so to speak, with the institutions. If that's exactly what's happening here, then we're going to find probably some interesting opportunities. And this goes hand in hand with industrials. And so I like the two together, obviously. And I think for the next couple of quarters, you'll see some interesting names there. Now, technology, discretionary, and communications are all in this downtrend. They have just not been able to really sustain a higher trend to the upside, I should say. And look, there are moments of greatness here along the way. And as we point out on a weekly basis, there have been right now about 4 rallies in the S&P this year when you look at them on a weekly basis, the way I look at them anyway. And, each time you saw technology kind of doing its thing and trying to make a move, but on a longer term chart, it does not look like it's changing trend to the upside. Not yet, anyway. Pockets of greatness are just not trend changes. So that's interesting. XLU, now this one's for utilities, man. They've been pushed around. They're very much a bond proxy. There's no doubt people, migrated to them for safety, and then obviously quickly retreated and left them, kicked them to the curb, so to speak, also quickly. So just as quickly as they ran up, they ran back down and took away almost all the gains of 2022, and have kind of settled into a better position here, but not looking great. Communications, and again, and discretionary just all look pretty much the same as tech on a massive downward trend. Nothing changing there at all. Not liking these charts at all. This continuation of downtrend is just not a place that you want to be involved in. I'm just not going to chase any kind of, again, small moments of greatness. It's just not worth it. XLP, from the consumer staple standpoint, same thing as utilities here. They were kind of kicked to the curb pretty quickly when things started to pick up a little bit. And I think when you start to look at these names, you can understand, the names of Kimberly-Clark and Colgate, Palmolive, and things of that nature, all obvious consumer staple companies. But really, again, a sideways trend. But from a relative standpoint, it's done its job as a defensive. So you can't argue with that. Now, real estate is typically a better inflation hedge. Just didn't, from this standpoint, when rates rise so rapidly, this is a blow to the real estate sector, no matter what. And it's an interesting situation. But again, there are a lot of commercial real estate names in this particular ETF. But I'm not rushing in to try to sort of bottom fish here. Again, we call that the most expensive sport in the country. And so when I look at the S&P, we do this again. I kind of draw these on the bullish percent. Now, this has been picking up. I can't say it hasn't been. It's above trend, no doubt. And we're on rally 4 here. Now, we talked about this just a few weeks ago that we can get into this wedge, and we did. We're right here, all right? And now we're starting to see a bit of a rollover in the S&P. And so that's interesting to me. I think rally 4 might have seen its heyday. And why do I say that? This chart right here is going to hopefully clear some of that up. So what I'm seeing is another formation of a different head and shoulders here, and the consolidation trend really that started back in May and has been lasting up until just recently. So we had a big push back to 4,300, back to that neckline, oversold, sort of conditions just got out of control, and then rolling over here again. Now, what I'm pointing out here is something on the ACP platform, that I'm able to build. So I can take the drawing tools and kind of draw some things. Now, I just measured between these two areas, right? The formation of the head is about 410 points from the neckline. And if you take 410 minus that neckline that I picked out, okay, it's my neckline. There might be better necklines out there. I don't know if somebody has different levels. I'm getting pretty specific with 3790, and 410 points from there is about 3380. So can it get through there? Of course it can. I mean, my first one was 3750, and we went all the way down to 3500 on an oversold basis. So I would just pay attention, to this level. Now, NASDAQ, I got to save my chart here. Always a nice feature there. In case you change something, you want to be able to save it before you move on. I like that. And the NASDAQ here, now, this is interesting to me. I'm just going to point this out, and I might do more of an in-depth write-up on this. But I just noticed something today that this really hasn't happened in the NASDAQ. When I say this, I mean the 50 crossing over the 200 on the ratio chart. Sorry, crossing under the 200 on the ratio chart. Now, the last time it happened was August of 2001. And it happened a few times here, but let's put things in perspective. I'm talking about a massive run-up. Remember, in the late 1990s, right, the run-up that we saw was incredible, right? It was an absolutely massive move. We had a similar one here, not as extravagant or as accelerated a move as we did in the late 90s, but we had a pretty good run here. And that was a space between these two moving averages that's pretty large. And the fact that it's now moving to the downside, where the 50 is crossing on the 200, that really hasn't happened since 2001. So I know it happened here a few times, but we were kind of in a consolidation and a regrowth mode. And we remember what happened in 2008. But I'm just pointing that out. I wanted to make a note of that before we moved on. Okay, I don't have a lot of time here, but I'm going to just show you a few things. One, we have a newsletter called Powerfeed, right? All you have to do go to chaikinpowerfeed.com and sign up for it, okay? In Chaikin Analytics, we have the ability to screen. And I had a screen that was kind of built to show names that have rallied, but have rallied on weak technical indicators, okay? And names like Chipotle Mexican Grill is kind of like meandering here, that you're seeing relative strength not be great. But here are some of the names that I saw, one being AMD. Again, in a downtrend, getting this rally mode, earnings weren't great, but the industry is strong and the trend here is changing. But I do not see the relative strength agreeing with that trend change. And some other names like Google's in here. As I said, Nike here. There's the list of names I wanted to go over, so that I think are obviously an area where you can fade the rally on some of these names. Okay, everybody. Unfortunately, that's all the time I have today. Thank you so much for tuning in. We'll be back next week. Take care and have a good one.